Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Algorhythm Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath. Now, looking at today's case study, I have to admit, when RIME popped up on my screen, I thought I was looking at a database error.
I can see why it's a confusing one at first glance.
We're looking at a company that is somehow a legacy karaoke manufacturer and a cutting-edge AI logistics firm at the same time. Make it make sense for me.
It definitely looks like a glitch, but it isn't.
Okay.
What we're seeing is probably one of the most radical and, frankly, bizarre corporate pivots we've seen in the last decade. You are right to remember them as the singing machine company.
Right. I knew it.
For 40 years, if you walked into a Best Buy or a Walmart and bought a karaoke system, it was likely theirs. But that company is, well, it's effectively gone.
Gotcha.
The business unit, yeah. It's been divested. The company's rebranded as Algorhythm Holdings, and they have bet the entire house, every single chip, on artificial intelligence and logistics. They sold off the whole legacy consumer electronics business to the Stingray Group.
That is a wild swing. I mean, usually you see a company pivot from, say, hardware to software in the same niche, but going from Sweet Caroline in your living room to optimizing freight routes in India, that's bold.
It is.
Before we get into the tech, why? Why dump the karaoke business? Was it failing?
Not necessarily failing, like going bankrupt, but it was a low-margin, inventory-heavy business. Think about it. You have to make plastic boxes, ship them overseas, store them, hope people buy them for the holidays. It's tough to scale.
A lot of overhead.
A ton. The board realized that if they wanted to unlock real shareholder value, they had to clean up the balance sheet.
This is a classic shed the dead weight strategy.
Precisely. By divesting the singing machine, they didn't just change the name, they stopped the cash bleed, they cut their operating expenses way down and improved their liquidity.
Which let them become
what we call a pure-play AI model. All those resources tied up in microphones are now focused entirely on their new platform, a company they acquired called SemiCab.
SemiCab?
Yeah.
Okay, so this is the new engine. And looking at the revenue, it seems like this isn't just a concept car. They're actually generating sales here, right?
They are. And the quality of that revenue is what matters. In the past, it was all seasonal, Q4 holiday shopping.
Right.
Now it's coming from managed transportation services. They're targeting huge enterprises, manufacturers, FMCG companies starting over in India. And they start with these small pilot programs, then expand them into multi-million-dollar contracts.
Okay, which brings us to the financial reality, though. I'm looking at the numbers.
Yeah.
And the ink is still red. They're posting net losses.
Yeah.
If this pivot is so smart, why aren't they profitable yet? And
that's the trade-off. You have to look at the context. Yes, net losses. Yes, operating margins were declining in 2024. But that is classic early-stage growth behavior.
So they're in an investment phase.
Exactly. They are eating the costs of the transition now to set up for higher efficiency later. The whole argument is that software scales much, much better than hardware ever could.
Okay, so that's the backstory. Karaoke's out, AI logistics is in, but let's talk about the product itself. SemiCab. You say it's a logistics platform, but I feel like every company says they have AI logistics now. It's a buzzword.
It is.
What's it actually doing? Why is this better than, I don't know, a really smart guy with a spreadsheet figuring out where the trucks go?
It is so much better than a guy with a spreadsheet because it solves a problem that human intuition just can't handle at scale. It's called the empty miles problem.
The empty miles problem.
Yeah.
Right, break that down for us, because I'd assume if a truck is driving, it's making money.
You would think so, but you'd be wrong. In the trucking industry, a huge percentage of trucks on the road, sometimes up to 30 or 40%.
That much?
Yeah. They're driving completely empty. A driver drops off a load in City A, then has to drive to City B for the next pickup. That drive from A to B, that's zero revenue.
It's just dead weight loss. Wasted fuel, wasted time.
Exactly. Now, a human broker might try to find a load for that gap, but what SemiCab does is use its AI to create what they call fully loaded round trips.
So it's playing Tetris with the trucks.
In a way, yes, but it's predictive. It's not just reacting. The AI looks across a massive network of shippers and predicts where capacity will be needed. It then stitches together a continuous loop.
So it's more collaborative.
That's the key. Most digital brokers are just matching one load to one truck. SemiCab is trying to build a collaborative transportation network. They orchestrate the whole fleet.
Which means?
Shippers pay less because they aren't paying for empty miles, and carriers earn more because their wheels are always turning with cargo.
That sounds like a win-win, which always makes me skeptical. Who loses here?
The inefficiency is what's losing.
Yeah.
And the traditional brokers who rely on that inefficiency to charge high fees, they lose out. If this works, it creates a serious competitive moat.
That's the stickiness factor.
Exactly. This isn't just an app. It gets integrated deep into the client's supply chain operations. High switching costs. Tearing the system out would be a logistical nightmare.
You mentioned saving money, but I saw a news release from February 12th, so very recent. The numbers were staggering. Usually you hear we improved efficiency by 10%, and that's great. These guys are claiming something way higher.
The data release showed that the platform is enabling clients to scale their freight volumes by 300 to 400%.
300 to 400%? That sounds like marketing fluff. How is that physically possible?
It's not about driving faster, it's about utilization. If a truck was previously sitting idle or driving empty 40% of the time, and now it's utilized 95% of the time, you've effectively tripled the output of that single asset.
Without buying a new truck.
Without buying a new truck. And the key thing here is, these aren't simulations, this is happening in live deployments.
So real trucks, real goods, real clients.
Yes, it supercharges their existing infrastructure.
That is the definition of leverage. But we know cool tech doesn't always equal a good stock. We need validation. Who's actually signing the checks?
Adoption takes time, but we are seeing high-level validation. The biggest proof point came in January of this year. They announced a major expansion with Hindustan Unilever.
Unilever. Okay, now we're talking about a real heavyweight.
Massive. Hindustan Unilever is one of the largest fast-moving consumer goods companies in India. They move everything from soap to soup.
And this wasn't just a handshake deal.
No, this was a contract expansion, valued at roughly $1.6 million.
Now, play devil's advocate. $1.6 million. Compared to a giant like Unilever, that sounds kind of small. Is it enough to move the needle?
For a company of Algorhythm's current size, yes. But more importantly, it proves the concept works in India, which is an incredibly fragmented and chaotic logistics market.
The ultimate stress test.
You got it. And the fact that it's an expansion is key. That tells me the tech actually works in the wild. It validates their land and expand strategy.
So we have the tech, we have the validation. How's the market reacting? Is anyone noticing?
The market reaction has been undeniably bullish, specifically tied to this news. When that freight scaling news hit, the stock jumped in after-hours trading.
Always a good sign when the smart money moves while the rest of us are sleeping.
It indicates momentum. The stock has been showing up on pre-market mover lists, so even if the broader market is neutral, IME is generating its own gravity.
It sounds like traders are sniffing out a breakout.
They are. The technicals imply strong momentum. You see higher highs. There's a group of traders looking at that small market cap, seeing these huge efficiency gains and thinking, if this catches on, this thing could really run.
Okay, you're getting me excited. But this is smart wealth. We have to be responsible. What's the bear case? Why should I be worried?
And there are legitimate risks. We cannot ignore them. First and foremost, let's go back to the financials. They are burning cash to fuel this growth.
And burning cash means you need to find more cash, which brings us to dilution.
Correct. Which leads to the financing risk. To keep the lights on, they have a deal with a group called Streeterville Capital.
Streeterville, I've heard that name. That usually involves, let's say, creative structures.
It involves prepaid common stock purchases. In plain English, they're selling stock to raise cash, which can create significant selling pressure. It increases the share count.
Dilution. The enemy of the early investor.
Exactly. It can put a cap on the upside. It's a common survival tactic for a company at this stage, but it's risky.
And I saw something else in the filings that made me twitch. They disclosed material weaknesses in their internal controls. It sounds bad.
It signals execution risk. It means their financial reporting processes aren't as tight as they should be. It could be legacy systems from the karaoke days that don't match the new model.
So not fraud, but sloppiness.
Operational immaturity is a good way to put it. Now, to be fair, they are using some non-dilutive facilities to help with the cash burn, so they aren't only selling stock. But it's something to watch.
Okay, so a high reward play with some genuine high risk hurdles. So if I'm watching this, what am I looking for in the next few months? What's on the catalyst calendar?
A few key things. First, obviously, earnings. We need to watch for the Q1 2026 release.
What's the key metric in that report?
I want to see if that SemiCab scaling is translating to the bottom line. Are the losses narrowing? Is the cash burn slowing? That will tell us if the business model is working financially.
Okay, earnings is number one. Number two.
Events and news flow. We need follow-ups on Unilever. And crucially, are they landing any pilots in the U.S.?
The U.S. market.
It's the holy grail. They've talked about pursuing sauce revenue in the States. If they announce a U.S. pilot with a recognizable name, a Walmart, a Pepsi, anyone, that would be a massive catalyst.
That would re-rate the stock immediately. And third?
The macro picture.
Yeah.
There is a general sector rotation happening into AI logistics. Everyone wants efficiency. That's a tailwind for them. Even without news, a rising tide could lift their boat.
So the wind is at their back, if they can keep the ship from leaking. Okay, we've looked at the karaoke past, the AI future, the massive efficiency gains, the dilution risks. Time for the final verdict. What's the Smart Wealth score?
Taking everything into account, the pivot, the tech, the risks, I'm giving Algorhythm Holdings a 7 out of 10 bullish score.
7 out of 10. That's pretty strong for a company with net losses and material weaknesses.
Yeah.
Justify that.
It comes down to the asymmetry of the trade. The catalysts are very strong. You have a platform that is proven to scale freight by 300 to 400%. You have a contract with a global giant.
Tangible wins.
Real, tangible wins that, for me, offset the early-stage balance sheet risks. And management is serious. They aren't clinging to the past. They are all in.
So how do we play this? Is this a buy and hold for 10 years kind of thing?
I wouldn't go that far yet. I view this as a swing trade.
A swing trade.
Yeah.
So we're dating the stock, not marrying it. What's the horizon?
About a 3 to 6 month window, looking toward that next earnings report. The idea is to buy ahead of a potential U.S. SAWS ramp-up. You're betting the momentum from Unilever will carry it higher.
And if the earnings report is bad?
Then you reassess. If they fix the balance sheet later, maybe it becomes a long-term hold. But for now, you trade the momentum, ride the wave, but keep a parachute handy.
A watchful buy. All right. From karaoke kings to the kings of the road. A very unique story. And hey, even if the stock doesn't work out, at least they aren't stuck with a warehouse full of unsold karaoke machines.
The small mercies.
Indeed. That's a wrap for us today. As always, take a look at the charts yourself. Do your own homework.
And watch that Q1 earnings date.
We'll see you in the next stock. Stay smart, everyone.
Big eye.